Today, a very timely topic. Since the last couple of weeks, these announcements with the Fed and the mortgage rates and the quarterly forecast and the market and all this stuff, we're going to update everyone on pricing and cash flow and IRR and what is happening in the market with some actual real live inventory. Welcome, everybody, to your weekly edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me today, my buddy who's a little bit under the weather, but I still call him GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and his name is still Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you today.
It's good to be with you, man. I feel like we were supposed to hang out this weekend. You weren't feeling good. You're still kind of like fighting back, man, but you're here for the show.
You know what? You got to show up. You got to show up. When the stage is bright, the lights are brightest, you got to be here, baby.
They call you the primetime player.
You know what? You guys fill my bucket. Here we go. We're ready to rock.
Big show. You said that you spent 3 hours prepping for this, GC.
You know, it was one of those things where there are some shows that require a ton of prep, right, for our shows. And there's some that Pablo and I put together, and, you know, there's less prep required. It's more of us just kind of pontificating. Yeah. And then there's some shows where you don't think there's a lot of prep, and then you get into it, and you start running scenarios. You start thinking of things that we can really teach and educate, and this was one of these shows. So Sunday night when I was at volleyball practice for my daughter, I didn't really see a lot of the serves that she served.
Were you working on your Excel sheet on your phone?
This is what I've done for the last few Sunday nights. It's just, you know, I'm just the guy at volleyball practice with my laptop out, like financial engineering and cranking and producing presentation slides. So, you know, but that's what it is. It's going to be a fun show today.
It's going to be a fun show. We got a couple later check-ins, Misty and Troy Johnson.
Oh, wonderful.
Top 10.
There we go. Top 10.
We got Sergio Prieto with a big Go Gators.
Go Gators. How about that victory?
Welcome to the SEC, Texas. That's right.
Sergio just put 3 new properties under contract with JWB.
Love that. I love that for you, Sergio. I'm a little jelly. We got the maven from the mountains of Denver.
Leslie Wilson.
Leslie, I feel like I haven't said your name in a while. Good to have you back, my friend. Who else? Robin Schofield.
All right, Robin.
New Hampshire. Good to have you. Sarah Jennings from New Jersey is back.
And you said her name correctly. Way to go. Only took you like 14 times.
It only took me 14 times. So you're welcome, everybody. I have a hidden talent of messing up names. Speaking of nothing, segue.
Worst segue of all time.
Worst segue of all time. I heard that this community likes to save on taxes.
Yes.
Is that true? Is that true? Let me know. Let me know if you like to save on taxes over there. Well, we got an event that's coming up where GC is going to be joining a panel of experts. It's a death battle fight. No, I'm just kidding. It's a panel of experts talking about different income tax strategies of keeping more of what you earn with our partners over at Tardis. They're hosting this thing. Joanna is sharing the link in the chat. We would love to have you show up and cheer for Greg. I bet you Courtney and Laura do not have the Not Your Average community in there cheering them on and saying that everything that they say is brilliant. And you might learn something new, right? So if you'd like to save on taxes, listen to Greg with other experts.
You know, guys,
say about that?
Yeah, absolutely. It's a great honor to be on this panel. So I'm super thankful for Tanisha, who was our guest last Tuesday, Tanisha Souza over at Tardis. But this is a really timely topic, guys. There are some big things when it comes to topics like bonus depreciation that take these tax savings that we already have built into this wonderful asset class that we love, rental property investing, and could potentially save you tens of thousands of dollars more from some of these things that are available now, bonus depreciation being one of those things. So if you're curious about it, if you have some big gains that are happening tax-wise and you're looking at ways to offset those gains, this is a session really built for you. So I'm excited to be a part of it. And like you said, I'd love to have the support. It would be great for our community to show up in full force.
You're the only dude on that panel. So
I was raised by a single mom, so I'm good with being around.
A good feminine energy. I mean that as a compliment in every way as possible. So the link is there in the chat. Just go ahead, throw that thing on your calendar. Hall of Fame first baseman Jim Kirko checking in.
All right, I haven't heard of him haven't heard from him in a little while.
He was asking, did anybody happen to catch that Monday night game last night?
Oh, how about that? Oh, Jags. Man, what a game!
Jags showing up. I watched the replay, the highlights this morning. Yeah, I don't have the energy.
You know, now that's the baseball playoffs too. You know, the Hall of Famer is going to show up.
Jim Kirko.
Just imagine it.
He's over here.
He's here every show through the World Series for sure.
Love it. All right. That being said, we got a Hall of Fame show today.
There we go.
Because like you said, GC, you spent a whole bunch of time preparing about what is happening in the market right now. And, I think the fundamental question of does it make sense to buy a rental property today based on these changes is something that we're going to answer as we get prepared to answer this. Just understand that this show is informational purposes. We're not financial advisors. Do your own due diligence when it comes to investments that you're getting into, no matter who tells you it, right? And if you want to talk to an expert, go to chatwithjwb.com. Hop on the phone call with us if you want to talk to us, or you can call JWB at 904-677-6777 and text 904-293-0341. Last but not least, we've got the Q4 2025 Jacksonville Real Estate Market Outlook. I see a couple of friends of ours in the chat that haven't said their name in a while, so maybe you don't have this thing yet.
Yeah.
But this is the forward-looking Q4 Real Estate Market Outlook. Make sure that you scan it. Make sure that you get a copy of that. We would love to put it in your hands. GC, you said that you spent 3 hours preparing for this. Why?
Well, this is a portfolio of the month show. We do these about twice a quarter, and it's always a ton of fun. But I think this one's a little bit more important because I think there's just a difference to the way that I see rental property investing today versus what the average approach is right now. And so I wanted to dig deeper. I wanted to, kind of make it a little bit clearer as to why I see right now being such an advantageous time to buy rental properties. Okay. So I wanted to put the work in and try to make it clear there are some clear advantages today, even from 6 months ago or even going back to years in the past when we know that it was an absolute no-brainer to buy rental properties. And so I wanted to kind of accentuate those.
Well, let's start with two kind of things, right? Like one that everyone's talking about, this drop in mortgage rates, I think bears analyzing. I'm assuming that is creating a positive scenario for rental property investors right now. You want to explain it?
Yeah, absolutely. A drop in interest rates is really important for a couple of reasons. Number one, when it drops your interest rate, it immediately boosts your cash flow. And so we all love more cash flow when we can get that.
Yes, we do.
So we are all rooting for lower interest rates. But what many people may not think about is a drop in interest rates also potentially decreases your amount required to invest substantially. Yeah. So a 0.5 point drop could drop the amount that you need to bring to invest in one rental property by $5,000, $10,000, maybe $15,000. So it's a double amazing thing. I don't know what you want to call it. It's a double win when you have lower interest rates coming our way, and it really, really makes a difference. So I just went back to just June of this year to see what our average 30-year mortgage interest rate was across the country. As you can see it here, it was around 6.9%. Today, it's about 6.3%. And, JWB clients always get lower interest rates because of our lender network. And so JWB clients back in June were getting an estimated interest rate of about 5.5%. Today, under 5% is what folks can get.
Greg, I just ChatGPT'd this. A double win is often called a double whammy or a win-win scenario.
Well, I was thinking double whammy, but whammies are bad, right?
Bad?
Yeah.
Double positive whammy. Anyways, win-win scenarios.
There we go. Win-win. No, but then
it's a double win.
It's a double win.
All right.
Anyways, is a double win the same as a win-win?
What I think about the win-win is what you just said, right? Like this idea of increasing cash flow and also potentially reducing the amount of money needed to get in at positive cash flow.
Yes.
I see it as something that's good for those of us that were ready to invest. And it also opens up the aperture, which is what I like to say. Well, I don't think that's adequate, but
But you say that whenever you can, even if it doesn't apply.
That's why I said it. That's why I said it. It also increases the amount of people that can get it.
Right.
Right? Like if all of a sudden you can invest at a lower price with positive cash flow, or there is just more cash flow, that makes it so folks with either a little bit less money up front or more that they were going to plan on in reserves, maybe they start being able to consider this because it now fits their risk profile and fits their experience that they want to have.
100%. What are the two biggest reasons that people say that they can't invest in rental properties right now or choose to not invest in rental properties?
Money and cash flow?
There you go. Right? You solve both of those with this win-win, double whammy, double win, or whatever this is. But it's good.
Got it. So speaking of double win, so there is this piece of the interest rates, and there is a new incentive combined as well. Right?
It's a new/old incentive.
Okay.
Right? So, but I wanted to point out how much the incentive matters today versus what it was just 6 months ago. Yeah. So this incentive that JWB has been offering is a result of interest rates being higher than what we all want. And because we are vertically integrated and we are absolutely motivated by you hitting your goals. And in order to do that, we need to get positive cash flow right off the bat for you. We have decided many months ago to go ahead and increase our incentives to be able to allow folks to do that. So the incentive back in June of 2025 was about $5,000 per property purchased. And that means that clients who bought in June literally receive a check within 30 days of $5,000 that they can use for any number of reasons, positive cash flow, reserves, whatever it is. And so that at that point, that was the most that we had ever given as an incentive. Again, interest rates are higher than what we all want. So that was the most we had given. Now, October, today, our incentives have been this high for quite some time. And we haven't really talked about it on the show, but I wanted to illuminate it here. So the incentive package per property comes out to about $14,500.
That's a lot of money.
Now. Yeah. And that is literally a check that clients receive. So you want to talk about a big cash flow hit? Boom, nothing better than 30 days in receiving roughly $14,500. So the way to get that is there's a $13,000 cash flow credit, plus JWB is waiving the first year of tenant placement fees. All in all, it comes out to about $14,500.
So 30 days in, you put this property on the contract, you close on it, it's already cash flow positive month one. 30 days in, you get 13,000 bucks in your savings account that you can put in as your rainy day fund / like to fund extra cash flow if you want to parse it out that way.
Yeah, exactly. In fact, the actual check is about $14,500.
Okay.
It covers the first year of the tenant placement fee. So yeah, you're talking about 15 grand back in your account, which again, rainy day fund, positive cash flow, you name it, it's all a good thing.
I want you to clear something up. You just said that as a vertically integrated company, this is kind of like why you guys do it. Can you elaborate a little bit more on the idea of like, what does this have to do? What does this incentive have to do with being a vertically integrated company?
You know, we've done many shows out here where we look at other evaluations. And has there ever been a show where we haven't found something that was wrong on another evaluation where they fudged the numbers a little bit?
Not whenever we look at other evaluations.
No. Yeah. So, you know, it's easy to fudge the numbers if you are not there on the back end managing the money.
Yeah.
And we are on the back end managing the money.
Yeah.
If we put an expectation out there for a client, there is nowhere else to go other than JWB if it doesn't work out. And that's the big difference. We're vertically integrated. We are the one phone number to call. And that motivates us to make really good decisions when we sell assets and how we prepare our pro formas for our clients. That eliminates the chance for us to fudge the numbers, because if we were to fudge the numbers, there's no way that clients would come back to us and fulfill their buying plans, and our business model would be at risk. You know, for other providers that are not vertically integrated, it is easier to fudge the numbers because they're motivated by the sale. They make the money on the sale. So if they fudge the numbers a little bit and maybe, you know, become too rosy in one place, or don't put any maintenance cost, or don't put tenant placement fees on your evaluation, well, they can still hit positive cash flow, but it's a joke. It's a joke. It's not real. So
it's a mirage.
It's a mirage, right? So
illusion.
But it sells.
Yeah.
It sells because, and it's a shame because people, you know, it's hard for people to get into this asset class. It takes so much courage to buy a rental property, especially if you've never met that person face to face who you're buying it from. You might be 1,000 miles away from where your rental property is. And the real shame is that it's so easy to fudge numbers on pro formas that many other companies do it. And what happens is somebody has a bad experience, the numbers don't line up, and then they never buy their next rental property again. And that's the real shame. So there's a difference between buying from a vertically integrated provider. It's the same thing that you all probably know with however you invest your money.
Yeah.
If the person on the other end is the only place to go to, win, lose, or draw, then they are going to be motivated to make more money when you make more money. And that's a time-tested, simple strategy to follow if you want to have success investing.
I love it. A couple of comments here. For that sub 5%, anonymous attendee is asking, is it also sub 5% loan for an LLC DSCR loan, or is that a different?
No, it would be a different interest rate for that product.
Okay. HT is saying, Hi, HC. Good to see you. The credit really helped us with our second STIRA property, right? So the credit still works for those. And Saren is asking if you're able to get multiple properties. Does this incentive count for each property, or is it a one-time incentive?
Yes, bingo, Saren. It's for each property you purchase, and there's no limit to the number of properties that you purchase.
Amazing.
Yeah, how about that?
So you can just rack those things up. All right, GC. So the combination of lower interest rates and extra, and how this incentive plays into it. What does it mean for if I'm as a property investor, like what am I thinking about?
This is what it means to you. It means higher monthly cash flows. So whereas before we were talking about largely break-even cash flows, slightly positive cash flows, now our cash flows are $150 to $300 per month.
150 to 300 bucks per month cash flow right now.
Yes.
Okay.
Now, instead of needing 30 or 35% down in order to get positive cash flow, now you can get positive cash flow with 25% down. And sometimes you can even get positive cash flow with only putting down 20%. So this is a huge change, and that's how it will require $5, 10, maybe $15,000 less per property.
Wow. So, okay. So $150 to $300 more in cash flow, like higher per month.
Yes.
$15,000 to $20,000 less to buy a house.
Yes.
That seems pretty good.
This is why I'm excited about it. And I want to accentuate it. It's a good time to do that. This is the right platform to do it.
Let's accentuate it then. Let's see this thing that you put together here.
Yeah, so I wanted to use real numbers, and I went back to June because that was, again, the time when interest rates were the highest this year. And I said, all right, let's look at a purchase today, and let's look at a purchase in June of 2025. All right, today I chose a property that's currently available on 19th Street. You've got your purchase price, $220. Today, you can purchase this property and it's still cash flow positive, and you can put 20% down. So that property only requires now about $61,000. Previous to this, we were preparing clients that on average requires about $75,000 out of pocket. So when I'm talking about potentially $15,000 less out of pocket, this is a great example. Your incentive package means that for this property, you get $14,457 that is delivered to you in cash. You do not have to wait for this for years and years and years. It is literally a cash check that comes to you within 30 days of ownership. And then because this is 20% down, you're able to get about $150 a month in cash flow year. That's an average cash flow over your first 3 years. And your rate of return is significantly higher. Mainly, it's the same property that we were selling before, but the debt is so much better now. And because of that, it increases your rate of return. You compare that to a great decision to buy in June for a similar property that was purchased then. Roughly the same purchase price, but putting 30% down required almost $87,000 out of pocket. The incentive package, still the highest at that point ever that JWB had done, but it was about $4,700 for that property. And your monthly cash flow was about $52. Overall rate of return, still where we wanted to be. We've been at between 9 to 10% for years now. But right now, it's a significantly opportune time to acquire because the debt has come down and because these incentives are still in place.
Yeah. To me, what I love the most about this is this. To me, the one that drives it is this like ability to put it at 20% down now, right? Like, having the ability to do that, we know juices the IRR, right? Because now you are getting more leverage, which means higher IRR. And of course, the lower down payment as well is so good. Like this, $26,000 less to get a house of roughly, like very similar price, and an extra 2% just on leverage alone, just on financial engineering alone. I love the idea of my money working even harder for me without me having to do any extra work.
100%, man.
Pretty cool, GC. Okay, so that's essentially what's going on, snapshot of June 2025 to today. Let's go ahead and let's do the portfolio of the month, right? Let's pick a real life portfolio scenario. Real quick, Alex Diaz is asking, any idea when the next JWB conference will be?
Oh, we're talking about the summit. And you know what? We are working hard on that internally right now. So I don't have a date for you. It is usually in Q1. It will be Q1 of next year. I hope to put to have something to share with you guys sometime soon here. We will, but I don't have a date for you as of right
We feel like we got to get going on that.
And I think this is what happened last year. I think the community
people just started nudging us, right? Like, because it's so easy to forget it, right? Like, it's like, we know it's going to happen. We have a million other things to do. A conference, like the summit is its own baby that we have to birth every year.
Right.
So we kind of like put it off until they start nudging us, and then it's like, oh, okay, we got to announce the same date.
We have received the nudge, and I appreciate it. It's going to be an awesome conference. I can't wait. Can't wait to have it though. We'll share that with you in the coming weeks and months.
Okay, sounds good. All right, so back to the portfolio generator. If you haven't seen this thing before, Gregg aspires, he has a part-time co-founder of a $200 million company that's developing 20 city blocks in downtown. He's a full-time aspiree for the Excel World Championships.
Yeah. I mean, I think a boy can dream. A boy can dream.
So he's put together this portfolio generator that is really another flex in the world of vertically integrated investing, right? Like it supports the thesis that if you're doing it the right way, you find the team first, the market second, and the property last, because the property will be really easy if you're dealing with the right partners. So on this sheet, we have essentially the features of the property, right? Like the property, the zip code, the different things you want to know, bedrooms and parking garages and square footage and year built and sewer septic. Then we've got today's numbers, which include purchase price, the percentage that you put down, the current rent right now, the property tax right now, property insurance right now. These are all real numbers. And then they have performance numbers of tomorrow, right? Like this expected maintenance percentage, vacancy percentage, rent price appreciation, home price appreciation, those types of things. That's, again, another flex of the vertically integrated model of really being able to control these numbers going tomorrow. How'd I do with that?
I think you did a great job.
I had to practice that.
I think you did a great job. And I'll just add here that this portfolio generator was developed really, I think, over the last couple of years. And it was built with you in mind because we heard from a lot of our clients, and I think it's a very normal and natural thing to want to be a part of, that they wanted to see how the sausage was made. They wanted to see how we were suggesting the properties for them to fill for their portfolio. And this is an opportunity for you to be a part of that process.
Yep.
So we always are going to make recommendations for you, but now you're going to get to see a part of it, and it's able to be done with you on the sales call. We're able to adjust things. You can ask a question like, well, what if I put 20% down here? What if I put 25%? Why should I do this? What should I do that? And so it's a really fun interactive process that if you're not a JWB client yet, this is how we would actually together form the right portfolio for you.
To show you how easy it is, I'm just going to do it in real time, right? So like this is the actual live inventory at JWB right now, right? We've got these 15 properties. I've selected all of them. We then go to this tab right here, which gives us the performance. And we're going to look at it and we're going to rank internal rate of return, then looked at its positive cash flow, and then we're going to look at initial investment, right, GC?
We are.
So as I look at this sheet here, I look for the 3 with the highest internal rate of return. That puts us at, you keep track of this, 1406 Ellis Trace.
Mm-hmm. Yep.
Then we've got 1596 30th Street West. And then we have 1138 17th Street. All right. So like we're going to select these first 3 to get started.
Let's do one thing before we do that though.
Yeah.
Okay. Let's go back there because I want to go a little bit slower because I want you all to see what we see as we're putting the right portfolio together. Mm-hmm. So what we have started here is with assuming 25% down. Mm-hmm. But as we just talked about, there potentially is an opportunity to put 20% down. Mm-hmm. So what signals to me that there might be an opportunity to put 20% down? I'll show you. It's all a factor of cash flow. If you can have positive cash flow, if you have a lot of positive cash flow, mm-hmm. then you might have an opportunity to put less down and still maintain positive cash flow. And why do you want to do that? You want to do that because the least you put down, while it's still positive cash flow, the higher your return on that investment will be. Mm-hmm. So as we're looking here in column U, right? I know that this is 25% down right now. Well, this column right here tells me what is your cash flow over the first 10 years of ownership. Mm-hmm. When I say positive cash flow, what I mean is I want your positive cash flow to be positive year 1, mm-hmm. and I need it to be positive for the first 10 years of ownership. Mm-hmm. So column U tells me what is your cash flow going to be over the first 10 years. So I see a number of properties here. I see $13,000 of positive net rental income, positive cash flow for 30th Street West. I'm looking at that and I'm saying, that's awesome. But I'm saying in my head, maybe that's an opportunity to put 20% down.
Yeah.
I see a few of them that have over $5,000 of positive net rental income. And in my head, I'm like, that's exciting, not just because of the positive rental income. It's exciting because I get to juice the return on investment potentially by dropping the down payment.
Got it. So when you're looking at this, you're thinking not just like, what does this look like, but what options does it give me to be a financial engineer?
Exactly.
All right. So do you remember the properties that we said, GC? What were they? Let's say.
Oh, and I wanted to point one more thing out, because this is kind of, this is something that, we have added, and this really came from feedback here on the show. You all said, well, how do you know that it's positive monthly cash flow year one? And my response was, well, every property is positive cash flow in year one. It just depends what percentage down we need to put down. And so we made it a little bit clear here on the evaluations as well. So monthly cash flow, this is the average cash flows for your first 3 years. What you'll find there is it, just like we said, between $150 to $300 a month in positive cash flow. Reintroduce the cash on cash return because our cash flows are so strong now. We're reintroducing that concept along with internal rate of return, which is again, between 10 to 12% now.
Got it. GC, is it possible to get a copy of this spreadsheet without, like Ernest is asking if that's possible?
It's not possible. You got to get on the phone with us. This took hundreds and hundreds and hundreds of hours to build this thing. It is a beast behind it. So it's proprietary. And honestly, if we just started sending it out to folks, you wouldn't know how to use it. There's a lot of things that you got to know how to use to make sure that this is easy for everybody. So you got to get on the phone with us. We're happy to build this for you.
Got it. And Leslie Brooks is asking, how are you determining the IRR?
The right way to determine the IRR. It's a great question. Yeah. Internal rate of return is the right way to analyze your return on investment for an asset that has where the timing of cash flows is different. So different years has different amounts of cash flows, and the amounts of the cash flows in those years are different. This is a high level way to analyze your return on investment, and it's what's required for rental properties. A rental property is like a business. It is like a mini business, and you're an entrepreneur, you're a business owner, I'm a business owner, many of you are business owners. We know that our cash flow is not the same every single year. Yeah. Some years it's a little bit more, some years it's a little bit less. Yeah. And so if you think about rental properties, they are a mini business as well. And so our cash flows one year is going to be a little bit higher, might be a little bit lower the next year. What you're looking at is, what is that return on investment, taking into account the fluctuations of cash flows and the timing of the cash flows. And so this is the right way to analyze properties. It may be a new term for some rental property investors because, again, if you look at other providers out there, you will see the same property that really has an internal rate of return of maybe 10% or 11% being advertised at 20% returns or 30% returns or 40% returns. And it's just not real because that's not how you analyze a business, and that's not how you analyze the return on investment for a rental property.
There you go. All right, GC, you've got the properties ready to call them out for me?
Yes.
Okay, good, because we're going to take a quick break, and I know a lot of people have joined us in the last couple of minutes. I want to promote the fact that everybody in this community loves saving on taxes and loves keeping more of what they earn, and our boy GC is joining a panel of other experts on Thursday to talk about how to keep more of what you earn. Joanna just shared it in the chat. We'd love it if you join there. Obviously, GC is going to need all the help he can get there because he's the only guy on that panel.
And I'll tell you, the reason that I get to be on this panel, a lot of it is because of our ability to bring a crowd. To be honest, our ability to bring a crowd. And so it's a big opportunity for us. And I think you're going to learn a ton from the other experts that are there. But yeah, if you guys can be there, it would be great, not just to have the numbers, but to have the quality of the individuals that we have in this community to be. It would mean a lot. So thank you guys in advance.
So the link is in the chat. We'd love it if you registered. And all right, remind me then, what are these properties? Oh, Mark Norman's asking, does IRR include appreciation? Yes, IRR includes appreciation.
It does include appreciation, but let me give a little bit more of a nuanced answer. It includes appreciation at the right time. Because what it does is it factors appreciation coming in at your liquidation. So that might be a 10-year liquidation for you or a 15-year liquidation, which the return component of that over 15 years needs to be taken into account as when do you receive the money.
Yeah.
Saying it another way, if you're going to sell in 15 years and you take that appreciation year one, that's a way to juice your returns, but it's not It's not real. You didn't receive the appreciation in year one.
Yeah.
And this is how other pro formas inflate their return on investment, because they'll put home price appreciation in year one, but in reality, you're buying and holding this thing for 10 years or 15 years. So long way, but for all of us data nerds out there who know a little bit more about internal rate of return, the simple answer to Mark's question is yes, it includes home price appreciation, but it's at the year that you receive it. It's not inflating it by pushing it forward.
I'm going to bring another term that I like to associate with IRR. It's something that we've championed here. It's outcome-based investing.
Yes.
Right? If you are trying to drive an outcome, like you have a date for when you need that outcome, and the IRR actually takes into account when that date is to give you a true rate of return based on reverse engineering from that outcome forward.
100%.
Right? So when you cash out, if it's to retire, if it's to, pay for your kids' college education, if, like these kinds of different things, IRR allows you to incorporate all 5 profit centers in relation to an outcome.
Well said.
You like that?
I love it.
Okay, yeah, whatever. All right, so we're going to go back to the sheet. Now we're going back to this first tab. I'm going to unhighlight these.
Well,
we're going to pick out.
Let's do something first.
Okay.
Let's go back, keep that 15th property there, and I want to drop it to 20%.
Okay. All right. Throwing some curveballs on me here.
I know. People like it. They know that we don't rehearse this ahead of time too much.
I did this wrong already.
There we go. You're all frazzled.
What's going on here?
Just put 20%.
I did put 20, but now it's just saying 20.
Oh, well, try with I'm not sure what you did, but go to a lower one and just put 20 in there. I'm sure there you go.
All right, cool. So now I can just drag this down.
Yep. And put, I'm not sure if you need the percent for the top one, but I would put that on the top one there. There we go. All right. So now let's go over to
go back to the sheet here.
Yeah, because I just want to show people what we're looking at. When people say, hey, listen, I can't buy a property if it has negative cash flow, it's all a factor of what you are putting down. And so our properties are built to be cash flow positive at 25% now, but there are some examples where we can put 20% down. And so here's largely how I'm going to select those properties, which we'll be doing in just a second. When I put 20% down instead of 25, now it's cash flow positive year one, but it's not cash flow positive over the full 10 years. And so I'm not going to choose those properties that are cash flow negative at 20% down. If there are some that are cash flow positive, those are going to be the first ones we choose. If that's not possible, then we're just simply going to go back to 25% down, which is where we saw many of those assets over $5,000 of cash flow over the first 10 years. So this is financial engineering. This is what JWB is doing on the back end to make sure that we're selecting the right asset for you guys.
So we see with the 20% down, the cash flow ticked down, the monthly cash flow ticks down a bit on all of them, but the IRR ticks up, right? Like what we normally tend to see.
There you go.
Along with kind of like the initial total investment also goes down, right?
Exactly.
Cool.
Exactly.
Okay. All right. I'm glad you threw that curveball in there, GC. All right. So now we're going to go back to 25 for all of these, right?
Well, no, we can stick to 20.
Are we going to stick to 20?
Yeah.
I don't even know what to. I just don't know what I'm doing.
Now let me give you the 3 that I chose. Okay.
All right.
I don't know if we gave the ground rules for how I'm choosing this portfolio.
We did. We looked at IRR, then we made sure that it was cash flow positive, and then we looked at down payment.
True. Additional, I was gonna talk about if you had $175,000 and you came to me, this is what I would do. So I'm working with a budget of $175,000.
Got it. Am I right on these right here? I remember it was Ellis, it was 1596 30th Street, and then 1138 17th.
You got it.
Love it. So this is where JC is talking about, right? This is where he puts the amount of money to invest here, right? So that's the assumption we're working with. And once we pick these ones, I'm going to just show something else new that we hadn't shown before just because we weren't working with a full portfolio, but the Pac-Man model is alive and well here, right? So like it is able to break out the different profit centers. As we always see, home price appreciation is the Pac-Man, right? When you lay it all out there. If you know, you know. That being said, GC, so now we are here with these 3 properties. Where do you want me to highlight it from monthly cash flow on like this?
I think these are our winners here.
Yeah.
It just happens to work out. I set the number at 175 before I actually went through these examples, but it just happened to be that there were 3 assets that we could have positive cash flow year one and positive cash flow over the full 10 years because we were able to drop it to 20%, we were able to increase our rate of return to and a portfolio weighted return of about 13%, if my math is correct, if my notes are correct. So what we've been able to do is to assign clear winners here. We've started with return on investment. We know cash flow is there. And the last thing is budget. And so look at the total initial investment of each of these three properties.
So it comes out to a little bit over 150.
Yeah. When's the last time we've been able to buy properties for roughly around $50,000 out of pocket?
3 properties for 150 that are cash flow positive. Pretty good.
It's been a while.
It's been a while.
So it's the combination of the lower interest rates while those incentives are still in place. And it creates the double win-win.
The double win-win whammy.
Win-win whammy.
The double win-win.
There we go.
That being said, GC, right? Like I think we've done this in shows past, right? When we do this and we see that there's 150, 160, your budget is 175, we also have the opportunity to go back to this thing, put it again at 25% and see if, like what you want is the returns at 25%. Right? Like now we have the opportunity to see that again.
Yeah.
More monthly cash flow. Now what you're looking for is cash flow sooner.
Yep.
A little lower IRRs, right? A little higher investment. Now we're right at much closer to that. We're at 184, right? So we're a little bit over that 175. So now you're thinking about, okay, do I want more cash flow? Did I want to just get in at that 20% and then put that extra 20 to work in maybe like a private lending or something like that?
There you go.
Or do I want to see if I can find another extra $9,000 and get in here and have this extra cash flow, right?
Or you could do a combination. We could put some properties at 20% down and some at 25%. Like for example, there was one property that was just, I think it was like $50 positive, cash flow positive. If you wouldn't mind, go back to that portfolio generator and the first tab and change the 17th property down to 20%. And the same thing with 30th and Ellis Trace, if you wouldn't mind. Yeah, 20% for both of them.
We're doing all of them?
Just those 3 for now.
Well, those were, but okay.
Yeah, just go back. see that the bottom one there, 17th Street, it's $50 positive. So if we had a client that was like, you know what, I feel better if each property is way more cash flow positive over 10 years. Well, that might make that client feel better, and they might say, well, I had 175 to put at this. It's only 158 right now if I put 20% down for all, but I just want a little bit more of a cushion. Talk with that client. Well, we might say, let's put 25% down on the 17th Street property.
Okay, so now 25% down on 17th.
Yep, just change that one. Yep, to 25. And now, boom.
And now we've got 167, maximizing the investment. You get way more cash flow positive in the first 10 years, and you still have this awesome rate of return.
Like, how cool is it to sit down in a conversation, a 45-minute or a 60-minute conversation, walk in and walk out and say, I know exactly the assets I'm going to buy. I know exactly how I'm going to buy them. Ask the questions you want to ask. Understand any fears or concerns you have. Overcome them through financial engineering and walk away super confident so you can buy your first 3 rental properties. That's the beauty of this portfolio generator.
I think it's, a telltale sign of vertical integration is making very complex things simple, right? Like when you have like one point of contact, one person doing all of it, you should be able to compress all these many, many different variables that come with investing in rental properties into a widgetization aspect of it, right? Like you've created this like manufacturing process for not just bringing these properties to market, but also the purchasing function as well.
There you go.
Very, very impressive, GC. Is there anything else you'd like to share?
Should we go into the rest of the case study that I did?
I don't see why not.
Okay. All right. Well, this is really where I started to go in on Sunday night at volleyball practice as I was whittling away on the computer. I started to think about just, right now we have positive cash flow, and that is awesome, right? The reason to buy this asset class doesn't change just because we have more positive cash flow today. It's always been about all 5 profit centers. But when we can get more positive cash flow, let's celebrate. It's awesome. But I started to go back and I was like, you know what? Let's go back to a time when everybody knows it was a no-brainer to buy rental properties, a time when people have said on this show, I wish I could go back to 2018 and buy as many rental properties as I could. And I wanted to reinforce how our clients are super successful because they made decisions based on all 5 profit centers back in 2018. And so I went and I pulled an example of a client who purchased in 2018. And I just wanted to show this to you guys. And I specifically compared it against June of 2025 because June of 2025 is very normal as far as cash flow when it comes to JWB rental properties here in Jacksonville. Well, what we found in June of 2025, we had an incentive package, which we always love. There was no incentive package back in 2018. Okay. So you didn't walk in with $5,000 in your pocket within 30 days. And you actually had more monthly cash flow in June of 2025 than you had in August of 2018. The big difference here is that in June, we had to put 30% down in order to be positive cash flow. Mm-hmm. In August of 2018, we could still be positive cash flow at 20% down. But that also means that this client had the opportunity to put more down and get more monthly cash flow. But we chose not to. And I want to show you the fruits of that decision. So when people are only focused on positive cash flow, I always talk to them about how they're leaving typically thousands of dollars on the table later on, either by choosing the wrong market or by putting more down than you necessarily need to put down. Well, I wanted to show you how that investment in August of 2018 has worked out, even though it was basically break-even cash flows.
And I think it goes without saying, but I'm going to go ahead and say it because I'm the noble fool of the show. But June 2025, this was before you could get all this like extra cash flow that you can get right now, right? So like we're saying this is at the top of price and interest rate on the market. You're comparing it to August of 2018. So you can imagine that if this compares favorably, then what you can do today is an even better experience.
Exactly.
Right? Yeah.
Today is just a luxury. The cash flow that we can create today is a luxury and we should enjoy it while also being rooted in the fact that all 5 profit centers are how you win in this game. Here is the actual numbers for this client on this property. This client actually owns, I believe, 6 properties, but this is one of his assets that he bought in 2018. He's owned it for about 7 years. His overall net rental income is a little over $12,000. You know what? I did the math on that, divided that by the number of months there. It comes out to $129 of positive cash flow per month.
Okay.
Is that high for you? Is that low for you? How does that feel?
I mean, that sounds about average over the time we've been doing this show.
Average, right? Certainly not going to change your life from a cash flow perspective. I guarantee you this client, he only expected 33 when he bought the asset. He is not going around, he did not buy 5 other properties because it went from 33 to 129. Like positive cash flow does not change your life today. But by financially engineering this in a way that we can maximize all 5 profit centers, look at what we've been able to do with this client, right? He's maximized his tax savings to about $3,500. He's paid down about $17,000 in principal. His tenant has actually paid that down for him. Mm-hmm. And then he invested with the right team in the right market. And because he only put 20% down, his return on investment is so much higher. He has about $121,000 in home price appreciation.
Nice.
For total profits of $154,000. And his return on investment, every year his money has been working for him at a rate of 23.5%. That's his internal rate of return. Like this is a huge win in 2018. Yeah. And then today, we still get to maximize all 5 profit centers. We still get to take advantage of the long-term growth of Jacksonville, but we just get a little bit sweeter with the positive cash flow that we have today. So that's what I got inspired to kind of put together on Sunday night. And I hope it kind of illuminates why I believe this is such a good opportunity to buy today.
Yeah. I would love to fast forward in 7 years and see myself to have 154,000 more in passive wealth creation.
You will.
Oh, that's right.
You will.
Oh, that's right.
You will. You will.
Oh, that's right.
And I know it was
because I have properties with JWB.
You do. And it's not a question. This is the most consistently performing asset class over a full market cycle. Yeah. So it's like we know the answers to the test. We just got to get in.
GC, I know that it's always a good time to buy rental properties, right? Like I think the idea of when we talk about the vertically integrated model, I think one of the underappreciated things that you think through when you build a vertically integrated company is that if you're promising people that you're responsible for like the full delivery of, if you trust in this for retirement, we're going to get you there. You've thought through the manufacturing and like the creation and bringing to market of the homes. You've thought through the making it easy to buy from a decision-making standpoint. But I think the underappreciated part of this is that JWB is consistently thinking, if you are building out a plan with JWB, you can count on the idea that we think through taking the pain away from market fluctuations when the media is hammering you and your friends are telling you that it's not a good time to continue on a plan.
Yeah.
Right. Like that to me is what's really apparent when I look at this like difference between August 2018, June of 2025, and right now. It's that you guys really, really think through. Like I think the uneducated person can think, oh, well, they're just coming up with incentives to sell homes. But really what you're doing is you are lessening the pain of people to continue the schedule and continue to work on a plan to be able to like set your clock to this way of retiring through an alternative investment that previously wasn't really doable until you guys figured this business out.
Yes. And, this is a company that has been here for 20 years and will be here for the next 20 years, 30 years, 100 years, whatever. It's that type of long-term thinking, right? This is like, we understand, like our returns are a function of what the market requires today. And what the market requires today is a function of what interest rates are today. And when interest rates are higher than what we want, we're going to, if we are here for the long haul, to see you retire, to see you send your kids and your grandkids to college, well, then our evaluations need to change because we are unwilling to fudge the numbers. Whereas others, it is a lot easier to fudge the numbers, right? Our margins on our properties are lower today because we care about the right expectations, and because we've already been here for 20 years, we're going to be here for another 20 or another 100 years. And other companies don't think about it that way. It's hard for other companies to make decisions that aren't short-sighted. So it's just who we are, and we're in a place where we can afford to make these decisions, to have lower margins, to be able to give incentives like this, partly because it's what the market requires, and partly it's because of how we're built as a company and how long we are going to be here to serve our clients.
You say it's like this like luxury to be able to like invest right now and have this extra positive cash flow. I see it as like, it's truly a luxury to be able to have a company to do business with that has been there, plans to be there, believes in goal alignment, and thinks in 20-year cycles like you guys do. Like I as somebody that has gotten to see the guts of this operation, and generally this has been my business school, and you've been the closest thing to a boss I've had in the last 5 years. I just never take it for granted that this like outlook is something that is so rare, because I look for it in other places and I don't generally find it, and I think it's hard to comprehend until that clicks in for you of just like how much of a luxury this is, man. So I think it's really, really cool as an entrepreneur to entrepreneur, bro.
Thanks, man.
Yeah, man.
Well,
Sure. That being said, that's it for today. Good job, buddy.
Yeah. Hey,
Good
no
job,
questions?
buddy. No, we had some questions
yeah.
that I peppered in here.
All right.
We've got a couple things coming up, right? If you want to keep hanging out with me and GC, we're going to be on next week, but I want to encourage you to join this like stop losing on income taxes, right? We want to support our boy GC when he goes on live with this panel of experts, learn a couple of things about how to keep
Did we tell him when it was?
money in your pocket. It's on Thursday.
This Thursday from 2 to 5:30 Eastern time. I'm not exactly sure when I'll be speaking on the panel. They're going to give me my times here pretty soon, but from 2 to 5:30 Eastern on Thursday is when we would love to have you.
Do you think you can do that without me as your co-host?
Oh no, I really can't do much without you, honestly. To be real, I hadn't really thought about that until now. Are you going to be there?
I don't want to.
Are you offering?
I just don't want to upscale your anxiety, right? But
you just be like right off camera, just like giving me like a thumbs up, like I did a good job.
We can talk about it. We can talk about it, GC. We can talk about it. All right, Il Maestro does have a question. If you have an interest rate in the low 6, when should you try to refinance?
Great question. Need more information, John? Please reach out to our team. So it's a factor of what your interest rate is. It's a factor of how much equity you have in the home as well, because what the goal is, and the reason that we would refinance, well, there's 2 goals. Typically, we might be able just to lower your monthly payment. What we also might be able to do, and it really makes a good decision, is when we can either keep your monthly payment the same and then pull a whole bunch of equity out and have that start working for you, either buying another property or doing another investment. So a lot that we need to help you analyze, but I think reach out to our team. We can put the numbers together for you. We love to do that. So let's get the party started.
Got it. Hall of Fame first baseman has a question for you. Jim Kirko, of course. In some past webinars, you spoke about investors who bought properties with no financing and liked the guaranteed income in their retirement. It would be great to hear how their portfolios are performing and if anybody has ever done this and pulled appreciation out for expenses, et cetera. Maybe a future webinar?
I love it. Okay, so now we're going to focus specifically on what's called a client journey, a client's portfolio that is all about cash.
Yeah.
Okay.
And have then used and then have tapped back into that equity post the cash purchase to do a creative thing.
Love it. All right. I'm writing it down. We'll do that sometime soon.
That sounds good. Joanna, write that down. Nadeem the Shaman Shah has a question. How's the downtown project progressing, GC?
Really well, really well. I can't wait for Summit. You guys are going to be blown away when we have our next meetup, which is the Not Your Average Investor Summit Q1. Guys, it is going so well. It is really fun because some of the things that we have been talking about for years now are opening up. I'll tell you one thing that's opening up in Q1 of next year, JWB's new office.
I was about to ask about that. Is Shaman talking about JWB's office or what, man?
Yeah.
When are you guys Q1 next year?
Yeah, we are moving in Q1 of next year. I don't have a date. Okay. I am really hoping it can be before Summit.
You know, I have extreme faith in construction deadlines.
Yeah, right. I know. We just prepped the team. We did a team presentation last week and showed everybody, you know, where we're, obviously they know where we're moving, but just some of the things like parking and how the space is going to look and where everybody is. We have a gym in the office. Yeah. We have a amenity floor. It's going to be great. So anyway, so JWB is moving downtown Q1 of next year. The big news for downtown is that we were able to lock up a premier grocer to come downtown, and it's in Gateway Jax's holdings. It's in Pearl Square. It's Publix. And for anybody in the Southeast, Publix is a premium brand for grocery store. It just feels better when you're in a Publix shopping, doesn't it?
Are you just doing a perfectly natural segue for next week's show right now?
Oh, that's right. I forgot about that. I didn't even think about it. Yeah. Man, this is awesome. Guys, getting a grocery store is one of the biggest moves that you can make is a revitalized downtown. We went from a food desert here in downtown to now having one of the premier brands coming and leasing our space here, Gateway Jax, of which JWB is a sponsor. So this announcement is huge. It's not just because of Publix coming. When Publix comes, guess what happens to all of these other retailers?
Everybody wants to do what Publix does.
They sign.
Publix is known for their real estate department.
They sign on the dotted line.
Yeah.
And that's what's happening here. So it is super exciting. And then next week, we said, how can we dive a little bit deeper? And we said, I wanted to illustrate just how momentous it is to get a Publix or a premium brand grocer to come to revitalize downtown. So we're doing the research. We're going to other downtown success stories like Nashville. I researched that the Publix in Nashville came in 2019, and we're looking at what is the effect on rents and home prices from that revitalized downtown, and from, as best the research we can find, from that premium grocer coming downtown. So if you want to get into the nitty gritty and get really excited about where downtown is going and the effect of bringing Publix to downtown, you're going to want to show up next Tuesday. It's going to be a great show.
I love it, bud. I'm going to be in Nashville for that show.
Oh, you're going to be in Nashville?
That's
awesome.
I will be zooming in from Nashville.
That's awesome.
It'll be very appropriate. Mark Norman asked a question. How about a practice question about taxes? Is it worth doing cost segregation for JWB properties?
Oh, Mark, it's like you're in my mind. You know, cost segregations are something that you got to analyze. What is the cost of doing the cost segregation study? And then what is the tax benefit? So sometimes it is worth it to do a cost segregation study. Sometimes it's not. It's a factor of how much are you able to write off. So generally speaking, it's not typically worth it to do a cost segregation study on a single family home because it costs too much to do a cost segregation study and the tax benefits are not strong enough. And the other way of saying this is like the tax savings you get just by doing normal depreciation on the property is good enough to offset your taxable gains. So generally speaking, it doesn't make sense unless you have a way to get a very low cost segregation study, or you have a big sizable gain that you are looking to offset. And if you have that, then doing a cost segregation study, along with learning about things like bonus depreciation, could write off tens of thousands of dollars more. So, long way of saying, listen, if you're selling a bunch of properties or you have a huge gain coming, a cost seg study might make sense. And that's why you should tune in on Thursday to this seminar that I'm going to be a part of, because it's going to introduce the concept of bonus depreciation along with rental property investing, along with some other asset classes. And so it really can be a strategy that can help some of you offset a tremendous amount more through a cost seg study.
Nice little preview of the Thursday webinar. I think you did great.
Okay.
And look at that. I wasn't even involved there, man. You got this.
All
by
right,
yourself.
I'm ready to go.
You
I'm ready to go.
you-
Well, it's only because you were next.
Okay, I'll take it. All right. That being said, I want to thank the community for being here. We had 80 folks here for an hour, taking the time out of your day to get educated on real estate, ask great questions. GC, I know you weren't feeling well this weekend. Still spent 3 hours prepping for this thing. You showed up today. You nailed it. I'm proud of you, man.
Appreciate it, man.
Yeah.
It's this community always fills my bucket and always brings the best down in all of us. So thank you guys for giving me the platform.
Catch GC on the Thursday webinar on how to save taxes. See y'all on Tuesday to talk about the impact of a grocer downtown, the underrated telltale sign of upcoming home price appreciation, I think is what it's called, something like that.
Mhm.
And last little piece of advice,
Don't be average.
See ya.